Hello and welcome. You're watching the newsroom right here on ET Now. I'm Ajaya Sharma. Well, the markets are doing very well in trade. It's the M&M, the stock, which is actually gaining very sharply as far as today's session is concerned after the strong commentary. Others giving company are Bharti, Axis, Techem, Bajaj, ICICI Bank. Overall, market is in good fettle. The big point is that broader markets have started to perform as well. So that's something to watch out for. N JayKumar is here with us to talk about markets and investing, somebody who has seen several cycles. Jakes, good afternoon and thank you so much for your time. First, your observations on how the market really digested the budget. We all often talk to market participants and we talk that budget is actually a non-event. But this time it appears it did turn out to be some event for markets, isn't it?
Well, as I said, the budget exercise typically has one big constraint, which is the budget deficit. Any planning that you do for revenues and expenses ultimately, leads to a certain deficit number, which has been the one marker which everybody in the markets and, literally economists and rating agencies have been taking cognizance of. However, what's happened in the last 1 year is that most governments which have given huge fiscal incentive stimuli have actually gone out and said that the deficit doesn't matter because this is one of those once in a generational year where you need to do whatever it takes for the economy to revive. And from that perspective, the deficit, rightly so, has been discarded. I would say discarded because once you say that 3.5 will become 9.5 in the current year and maybe 6.5 next year, etc., and you've given a glide path now to go down to 4.5 in 5 years from now, it essentially means that the old fixation, if you will, around the 3.5 number has virtually disappeared. And like in any budgeting exercise, the most important constraint, if it's removed, then effectively you're able to give and meet every single wish list of every market participant and some and more. And that's the way it's been. So you really have a situation where without constraints, they have been able to produce a masterclass in terms of what the markets needed, what the economy needs, and what can actually spur industrial activity, maybe even employment at the grassroots level, but more importantly, getting the animal spirits back in some form into the economy. And the markets obviously will take not just heat, but this is the single biggest takeaway from the market perspective.
Sure. Jakes, I want to understand from you, because you've seen so many different policymakers and their way of managing the economy, the market cycles, flows. Where exactly are we in the market cycle right now, and how is this bull run really playing out in your view?
I think we're in a very early stage of a long bull run. Markets, because interest rates are low, the dollar is weak, and the discounting, therefore, of future cash flows becomes at a much, much lower rate. Essentially, what you're doing is that the risk-free returns that the markets are expecting are a lot lower than in most cycles, where interest rates would be, let's say, at the 9 and 10% range or otherwise. In most parts of the world, 2/3 of the world, interest rates are negative. In most other parts of the world, they're literally kissing the 0-1 kind of range. So I think from that perspective, the expectations from markets or the ability to hold on to for longer period returns has gone up dramatically. And therefore, the markets have factored in a lot more than they normally would have, which is not just 1 or 2 years earnings, but in some cases, maybe even 3 and 4 years earnings. So from that point of view, I think we're in for a long bull market. I think we're in for a very ground up kind of bull market and a broad one at that. And therefore, a long from a time perspective, broad from a market from a market coverage point of view, more stocks, more sectors will get covered. And I think if you add to it the fact that manufacturing, everyone now looks at India as a given rather than as a choice to be made. I think you have manufacturing going for it. The two global facing stocks, sectors, which are IT and pharma, are rocking. And the local, whether it's infra, power, steel, cement, etc., you've got really an assortment of stocks or assortment of sectors to pick up from. Add to it the fact that China itself becoming more and more cognizant of polluting industries, etc., actually shutting down capacities, whether in the steel business, whether in the energy emitting business, or for instance in specialty chemicals, etc. You have a situation where a lot of manufacturing capacities, while technically existing in China, are now going out of production. From that point of view, China actually will end up, in fact, turning importer in many cases, not dumping the world with its produce. So if you add all this and put it together, I think we've got a great 3 to 5 years ahead of us. And we shouldn't be necessarily governed by the fact that the index may have crossed 15,000. That is, but really if you take it from a year ago, Jan last year to now, we are up from a 12,000 level to 15,000, which is about, I would say 25%, which, makes us a decently performing market. But there are many, many markets across the world which have done substantially more. So given that, I wouldn't necessarily be, at all points in time, you need to be cautious. But the fact is, I don't think public at large has participated. HNIs at large have not participated. They're still a worried lot. Participation and, in a sense, exposure building is happening at its early stages even now. So from that point of view, I think we have a long tarmac ahead of us, and wouldn't surprise me at all to see the index moving to much higher levels, but the broader market performing significantly better.
Right, Jake, as they say in the market, aapke muh mein ghee shakkar, all the viewers who are listening to us, because this time DIY investors have actually shot up in the market. In fact, they are the ones who have made reasonable returns buying the dip, sitting at home. Jakes, how are you really analyzing the return of the old economy? The Tiscos, the telcos of the world. SBI has made a roaring comeback like never before. Great commentary. Manufacturing stocks are coming back. M&M is back at 1,000. You've seen these guys all through the cycles. Do you think there's good valuation comfort compared to some other part of the market which is 70, 80 times earnings in this side of the market, old economy, part PSUs?
I think, even if I look at my own orientation towards portfolio creation right now, the way I see it is, I think there's significantly more action in the old economy value stocks. The important thing is that this time around in the cycle, and this is a paradox actually, that at high interest rates, corporate India was leveraged significantly. At low interest rates or no interest rates at this point in time, most corporate, starting with Reliance, etc., which was the big move to the net debt zero position, I think a lot of companies are going towards deleveraging, reducing debt. And while that might impact return on equity because leverage has come down dramatically, but the risk profile of the businesses have come down significantly as well. So as businesses move towards becoming zero debt, cash positive, you're seeing P's shoot up, enterprise valuations, which used to be a combination of debt and equity now, in most cases are largely equity comprised and not so much as a result of debt. And especially leveraged companies which are now becoming debt-free, there is the impact of not just the reduction in debt converting to equity, but also the valuation multiples for market cap going up. So a combination of all this, I think the old economy offers tremendous value. And add to it, by the way, the need for capex having reduced quite dramatically. So most companies have made no cash calls. Most of these big companies have made no cash calls on shareholders. So any demand gets met not through new issuances, but met through the market. And that's the other reason for the market expansion at this point in time.
Jakes, you're also, an investment banker, deal maker. You do speak to both the set of communities, the investor community as well as the promoters. Where exactly is the money flowing? Where is the interest of the investor community, both private equity investors, funds? Where are they looking for deals? Which sectors and what kind of companies?
I think typical private equity has been focused on, the troika, which I consider as consumer, technology, and healthcare. That's been traditionally where they have been looking at. I think a lot more will move towards old economy. That's number one. Number two, private equity is now being comfortable enough to even, look at controlled transactions. So a lot of first generation entrepreneurs now have run their stakes down to, low double digits or even single digits, with private equity holding majority control. So I see more of this trend where you will have good businesses where the first generation or even the second generation wants to exit, and that is seen as a normal sort of evolution in the market, and private equity coming in for controlled transactions. So ticket sizes are going up, a move to old economy continues. So if there is one space in the market that's got some kind of a bubble buildup, I would say it's the IPO space. But to the extent that the rest of the market is kind of under-owned, in fact, most old economy stocks are under-owned, and we're seeing a very healthy trend of promoters, the traditional family promoters increasing their holding. We are seeing deleveraging on the corporate side, and we are seeing the need for capital that they're asking for being reduced. All this leads to an expansion. And if you add to it the private equity pressure that's coming through in terms of wanting companies from an acquisition standpoint or from controlled transaction perspective, I think you're going to see tremendous action in this space. So maybe the old space of healthcare, consumer technology, while still being attractive because those are the cash flow positive spaces as people have been seeing them. But going forward, the move to from private equity perspective into old economy will be clearly seen. So packaging is one such space that you have a lot of action going on. We've had at least 2 or 3 private equity transactions and at least 1 or 2 more waiting to happen. So packaging, polyester films or PP films, etc. These are definitely spaces which are seen in the old economy. I would suspect that even cement, and more importantly, the distressed debt space, where a lot of foreign funds are coming in to want to own assets, that will continue. But the one evergreen space will be the financial services, which will be, always in demand from private equity, whether in good times or bad times. So, I've talked about 7, 8 spaces. So all of these will be AP focused or areas of PE interest.
I wish I could, take the details of those companies, etc. But let's, not go in that direction. But great chatting with you, Jakes. Always appreciate your inputs and contribution on the channel. With that, let's take a short